The funny thing is that I always see is when silver is $12, nobody wants it. When silver is $35, they start telling me how cheap it is. My expectation is silver will do better than gold.
Please join us for our next live stream, Sunday, March 28th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, March 28th, 9 p.m. Eastern. See you then.
Hello again, everyone, and welcome to another edition and episode of Silver Bullion Television SBTV. I'm Stephen T, and if you haven't done so already, please hit the subscribe button, as well as give us a thumbs up and like if you enjoy what we do, whilst at the same time hitting the bell button for notifications and updates from us, because we do really truly appreciate your support and thank you greatly for it. Now today we're here in the Safe House Precious Metals Vault in sunny Singapore, though you can't see it because we're indoors, but we're here to speak to Mr. Gregor Gregersen. Gregor is the founder of the Silver Bullion group of companies, including this safe house, and we'll be speaking to him about the precious metals market, as well as getting his views on some of the new tech developments and projects that his team have been developing over the years that might actually revolutionize the fintech and bullion industry at large. Gregor, it's an absolute pleasure to see you again. Thank you for joining us.
Thank you for having me.
Well, Gregor, there has been a lot of interest in silver recently, overflowing from the biggest story of the first quarter from last time we saw you. And that's the story of the GameStop stock saga. It's a bit of a mouthful there, where a group of retail investors rallied together on social media and managed to squeeze the Wall Street establishment traders who were holding short positions and say, hey, you know what, if we can do something of a David Goliath kind of scenario here, we can try the same thing with silver because it's an undervalued commodity. How do you make sense of the whole thing? And Gregor, also just let us know a little bit about whether you think this entire movement will prove successful.
So the story about GameStop that really caught my eye was the fact that GameStop shares were shorted by 140%. And you know, I've been in the industry before, and I'm very aware of what shorts are, but I could never realize that you can short a stock 140%. What that means, if you have 100 shares of GameStop, somehow 140 were actually short. And the way you short something is you actually have to borrow shares from somebody else to then sell them, and in order to later buy them, in order to bring that up. Now, it stands to logic, so it's the only way you can have short 140%. It means that somebody has to borrow the shares to somebody who sells them, who then somehow has to lend the shares to somebody else who also sells them to then sell them again. And so if the financial markets allow such lending of sold shares over and over and over to the degree that you have 140% worth of shorts, you know, it's no wonder that people are going to say, what the heck? I mean, this, you know, let's buy this thing and, you know, push it back up. What's new in this scenario, A, is the degree to which it was being shorted, which to me is amazing. The second part is the fact that it is now possible to actually get enough people which are likely minded together and actually act in concert to push something up. Now, GameStop, of course, is something risky because either way, nobody seems to care that much what the company is really about, and it's really about, you know, who has the more staying power, who can buy more and who can sell more and so on. And the up and downs, of course, was a really special case. But I think that GameStop introduced is a game changer in the sense that, you know, the Wall Street traders, the big funds, which sort of think they can short stocks, as I see, in order for technical reasons, in order to make short-term profit, and now have to contend with social media as well. And, you know, it means that there's a little bit more of a limit on what they can do and what they cannot do. And personally, I'm very glad to see that there's an increased interest in silver now because, well, you know, I think nobody really knows how much shorts really are out there. I mean, you can look at COMEX, you can look at some, but there are many other future exchanges out there. So I'm always a bit suspicious what the numbers are actually. Because remember, silver is a physical commodity, it's a distributed thing. It's not just traded on one exchange like a stock can be. So but nonetheless, there's a lot of shorts in silver. There's that idea of borrowing silver in order to short it, non-existing silver in case of future exchanges, and to do it over and over. That's very well alive, and that's basically why I wanted to buy silver and own silver myself back in 2008, because I realized this was a big opportunity. And so I kind of feel that now, 12, 13 years later, there seems to be a bigger movement with similar-minded people as myself that want to sort of push this up. So to answer your question, I'm very glad this is developing. The thing with silver is it's going to be, it's a commodity, it's the smallest commodity, but it's a much bigger sort of market than GameStop itself. And what I'm hoping is that this movement will stay alive, because silver is not something where you can sort of try to push things up, and because it can always be pushed back down with the future exchanges. But instead, it's really a matter of about accumulating the physical, because there really isn't that much out of it. And all these leveraged paper long positions are basically backed by less and less silver. And at some point, the market or enough investors are going to start to realize that it makes a lot more sense to dump the paper and actually go into physical, because the early people who do that are going to get the physical. The ones which are too late, they're not going to get any physical. It's just how it is. And so I'm very glad that silver, being sort of the forgotten metal, is becoming a little bit of a shine to it, and is on the limelight.
Is because there were some who were arguing, and might have argued, that the squeeze didn't really actually work in that sense. But David Morgan, as you know as well, he was saying he doesn't know how this will play out in the long run, because he believes the squeeze is still ongoing. What was your take on this?
I think it's a bit naive to think that you can just overnight sort of change a commodity market. It's something which you should look at purchasing silver and holding it for a long period of time, because things will play out. And the amount of volume of gold and silver out there, I mean, it's very large. There has to be a lot more physical demand coming in to really change things. So yes, it's not a short-term thing, but the movement in the direction is very correct. And owning, you take gold. Gold has been going up an average of 8% since 1971. And silver is very cheap compared to gold. So it's the type of asset which you want to buy. You can't really you can't go very wrong with it. And it is going to appreciate over time. So, but you need to have patience.
Gregor, in your extensive experience being founder of the SB Group, in the history of Silver Bullion as a company, how many times did you encounter silver shortages from suppliers, and how do the supply constrictions, especially in the past year, given the circumstances we've just had, how do they compare to previous shortages?
So I think since we started in 2009, we had maybe 3 or 4 times when it was really starting to get difficult to get bullion. But over the years, you have to differentiate about what kind of bullion, and that's an important thing here. It says essentially a retail type of bullion, such as 10-ounce silver bars, 100-ounce silver bars, coins. Similar thing in the gold market. You can say 100-gram gold bars, 10-ounce gold bars, maple leaves. Those are sort of the retail bullion that individuals like to buy. And then there's sort of the bigger bars, the 1,000-ounce silver good delivery bars, the 1 kilo, and especially the 12 kilo, 400-ounce gold bars. These are like $1 million each. So these are sort of the good delivery bars. So there are 2 different beasts, and that's important to keep track of, because for now we talk about availability and premiums. There are different characteristics going to each other. So when it comes to the retail side, in 2015, that was when I was writing an article, about what we saw, where silver started crashing from about 28 down to about 22, and we started getting a lot of purchasing demand because the physical buyer is somebody who's storing long term, and to him, the low price was a buying opportunity. So it's very different from the future contract buyer or the paper guy who's buying it now and selling tomorrow. And so what we've seen 3 or 4 times now is that especially on the downturn side, there's a lot of physical buying. And we are in a funny position because we have a product whose demand keeps on going higher and the price keeps on dropping. And as the price drops, people can actually buy more silver with their money, which makes it even worse because essentially it's a recipe for shortages. And because the price is not determined by physical supply and demand, but it's determined in these future markets, with all this borrowing and shorting and leverage going on, you have these inconsistencies. So 2015, we essentially were unable to get silver coins, bars, a retail type of bullion. And we're in a similar situation now. We are not even trying to get maple leafs or American eagles, for example, because most of these they're minted in the United States or in North America, in Canada, and they have to be shipped to Asia. And because demand in the US is so high, it's unlikely anybody is bothering to ship it to us because they have to sort of handle local demand in North America first. It's a little bit better if you're going to places like the Austrian Mint, in Europe. The funny thing in Europe is that, say in Germany, you have to pay a 19% sales tax if you buy a silver coin. So most of these Austrian Philharmonic coins, they actually don't get sold in Europe because of taxes. So most of them going for export. So the Austrian mints, it's a bit easier to get them. The Britannia coins are easier to get. But overall, our business nowadays has really shifted from the retail bullion more towards the good delivery LBMA side, meaning the 1,000 ounce bars. And as you can see around here, these are 1,000 ounce bars. Now on that side, we have seen an increase in premiums a couple of months back, but it's sort of stabilizing and it's actually starting to slightly come down. I was just checking the last couple of days. So demand is sort of stable and supply is stable. And that's what you have to understand. When a lot of the people which might be talking about premiums being high, they might not be making that differentiation. And if they're just talking about the retail silver sold by, say, Apnex and JB Bullion and all these well-known names in North America, that's just a small sub-market of the actual physical silver market. And so that's getting a lot of attention, but what matters a lot is that LBMA behind it. And to give you an idea, when we order these, we normally have to wait 3 weeks, 4 weeks. It's quite normal. But we have to order in minimums of 10 tons. So for American viewers, it's about 320,000 ounces at a go. And they come in containers. So we're literally getting silver in containers nowadays. So it's a very different dynamic. And that's the market. If that market, you cannot get that bullion, that means that Intel and Tesla and other producers and users of silver are going to start having problem getting silver. And that's when you're going to start getting a squeeze. So we're not there on a squeeze, but there's going to be a squeeze at some point. It's just that it's going to take more time, and it's going to be that LBMA market where the premiums have to go up.
Yeah, because we were actually going to ask you as well, with the onset of the COVID-19 pandemic, the word unprecedented comes to mind a lot, and you were just mentioning premiums earlier. Premiums today remain elevated from levels prior to the onset of the COVID pandemic. So we're seeing that decoupling, aren't we, where spot prices fall substantially, but people still can't go out there and actually buy the actual cheaper silver because there's a low supply. Do you think this is a sign that there is now a greater pushback from the physical market against the paper market in terms of silver pricing?
Well, so when it comes to pricing of silver, you So there are two different things you can, again, look at. There's the spot price, right, which might be, say, $25. And then if you want to buy a particular type of silver, there's a premium to it. So for Maple Leaf coin, I'll be very transparent. Say Royal Canadian Mint is selling at $1.50 above spot. So if the silver is 25, they're selling at $26.50. You need to get it to us. You need to get insured and so on. By the time we sell it to you, we're probably selling at, say, $2. So we earn 50 cents. So those are premiums in a normal competitive market. Right now, last time I checked, I think we had premiums at $4, $5. In some cases, went as much as $10 and so on, because people aren't able to get them. And those are basically the retailers trying to fight to get liquidity, to get these coins. And they have to pay a higher price, so they're giving that higher price over to the customer. And it has its own dynamics that comes out of that. So in our case, the retail silver prices went up with the pandemic. That was back in, I think, February or so of last year. And it never has come down to the pre-pandemic levels. And it is hovering up there. But then again, the industrial silver is still there. So if we're talking about a squeeze, which is going to put the sweat on Wall Street guys, we need to get the big bars to premiums to also go up by increasing that demand. And that's not happening yet at this point.
Which brings us to ask, how undervalued is silver right now?
So silver, I was kicking and screaming back in last year when silver went to 122 versus gold. So there's something called a gold-silver ratio, where you compare how many ounces of silver you need to buy 1 ounce of gold. And the ratio in nature is about 16 to 1. So we'll find 1 ounce of gold for 16 ounces of silver on average. And that was what it usually traded up pre-20th century. That was sort of the natural balance of things. In the 20th century, many countries sort of de-emphasized silver in favor of gold, and that ratio ended up going more towards 60. And that kind of used to be the average 60, 65 throughout the 20th century. Now, we had spikes going up to 80, and sometimes we'll go down to 45. And so the rules that I like to tell people, if it goes above 80, definitely buy silver. Sell your gold, buy silver, because silver is really cheap. If it goes below, say, 50, 45, you might want to do the opposite. Right now, we're around 65 or so we're somewhere in the middle of that. Last year, we were at 120. So I was telling people, if you want to buy gold, buy silver now, and you're going to have twice as much gold by the time this ratio comes back into a more normal range. And that range of 65, that's sort of the average, let's say, for the last 40, 45 years. Now, is that the right price for silver? I don't think so. I think silver should be, have a much lower ratio, which means silver should be a lot more expensive. And from the physical supplies and demands that I'm aware of, I believe that we will see silver, becoming more expensive versus gold, and definitely become a lot more expensive in dollar terms. So while silver, has recovered a lot from 120, basically silver went from $12 to about 25, 26, where we are today. So it doubled in price in 1 year. So despite that, if I have a choice, I will still go towards silver nowadays instead of gold. But it's no longer the screaming buy that it was a year ago. And the funny thing that I always see is when silver is $12, nobody wants it. When silver is $25, people start getting interest. When silver is $35, they start telling me how cheap it is. It's for some reason, when it's around 35, that's the time when the media is starting to report more about it, and it becomes more in people's minds, and they're looking towards gold, and suddenly it seems cheap at $35. So that's sort of what we've been seeing. So if you have a choice between gold and silver, buy what you think you're more comfortable with. I will tend towards silver, but 65, is a lot more balanced based on the last 50 years. my expectation is silver will do better than gold. So,
Because it's interesting you mentioned that, because we have also seen renewed interest in how futures exchanges, like the commodities exchange and even the exchange traded funds like the SLV, they're likely to not have sufficient physical silver to actually cover their outstanding futures contracts, as well as even their shares issuance, excuse me. So it's estimated that for each ounce of actual physical silver, there's up to maybe 250 ounces of paper silver, or some people say even 400 in existence now. And do you view this underbacking and leverage in paper silver as some kind of risk issue, where the whole market seems at risk of unraveling given the current supply situation?
So what got me into this business in the first place was very much that very fact. When I was working in Commerzbank back in 2008, Lehman Brothers went bankrupt. I was in trading room, seeing the after effect of that, and I saw people rush out to buy the physical. And silver prices kept on crashing, and I thought, hey, it might not be a bad idea to buy some silver myself. I figured out I couldn't get any physical because everybody had bought it up already. And so that's when it became very clear to me that there's a big difference between owning something as a physical asset that you can keep and having an IOU from somebody else who's giving you a promise, which is typically a promise on 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 a promise, because that's really what you end up getting. And when there's financial turbulence, you don't want to have a promise of a promise of a promise of a promise of a promise. So how do you get the physical? And that's what this is all about. And it's really a matter of education oftentimes to get people to really look at what is it that they're buying. And because oftentimes that silver indeed is not there. And one of my favorite sort of interviews that I saw is somebody called Kyle Bass, who basically manages a fund, and he took delivery of $1 billion worth of gold. And what applies for gold applies even more so for silver. So he took that delivery for his fund, and he was explaining how we went to COMEX. And basically, at the time, COMEX had about $80 billion in net long positions. So that's basically the amount of paper silver out there, net. And that was backed by, I believe the number was 2.7 billion in actual gold. So that gives you a backing of about 3.3%. Now, silver, it tends to be a lot lower than that. Now, Kyle, in this interview, he basically explained how he went to COMEX and said, hey, I'm going to take delivery of 1 billion of your 2.7. What's going to happen if you get another two guys like me? What are you going to do? And apparently this COMEX guy said, well, it's not going to happen. Well, what if it does? And his answer was, well, price will solve everything. And what he means when he says price will solve everything is whoever's going to bid the most are going to get it. So if you got 80 people wanting to get 2.7 of these units, the smart guy is already taking one, which let's say leaves 79 billion chasing 1.7 billion. How much who's going to get it? So because these 79 billion net assets, net long positions, don't understand that, what's the difference between physical and paper, so they're not concerned about it. But once people start awakening to this fact, that it makes a lot more sense to take delivery. And by the way, it actually, Carl Bass used to pay 90 basis points by moving from one future contract in another one. By taking delivery, I mean, you can store for 30 basis points, 35 basis points. It's, we're charging about 40 basis points at current prices, and as silver and gold goes up, our storage fee actually becomes lower. So you pay less than half what you would by having a paper position, and you have legal title ownership of the physical assets. It's a no-brainer. So I really encourage people to look up this interview by Kyle Bass and hear it directly from them. And that just is an illustration of how little physicals there is. And you know how in many ways it's all built on a house of cards. And you know, when you go out and you buy $5,000 worth of silver or gold, that's a relatively small amount. But let's take, you know, 5 or 10 of Kyle Bass's. Nothing's going to change. And that's when COMEX, you know, Warren Buffett did that back in early 1990s. He took delivery of a lot of silver. When he bought, nobody cared. When he said, I want delivery, suddenly silver prices ended up stacking up, and COMEX couldn't deliver, and COMEX actually had to pay Warren not to take delivery. And then a lot of people figured out, oh, that's actually a good idea. Why don't we all start asking for delivery? And that's when COMEX put in a lot of restrictions on how much silver you can take out. And I took delivery myself once to try the system out. Make a long story short, if you're industrial users, you most likely can get it. If you're an investor, you only can have a small amount, after which you won't be able to take delivery, because you can satisfy, you know, say 80 billion, if there's only 2.7 billion. And so ones which want delivery anyway, they're normally being given another paper silver on something else and asked to try and take delivery from the other one. So if you're investing in gold or silver right now in paper, I urge you to have a look at the small print and to look at how you can take delivery, because oftentimes there is a mechanism for taking delivery, but oftentimes it needs to have a special approval. It needs to go through a board, or you need to have a $5 million minimum, or you have some other thing in there, which makes it so that when you really need to take delivery, you will find out that you probably can't. So it's always a matter of gray. It's never a matter of black and white. To try to take delivery, if you can take deliveries, and you know you have a working system. But that's essentially what is happening in the industry, and why ownership of the physical is such an important thing.
Because it's so important to take actual physical ownership. Again, I don't want to keep quoting from David Morgan, but he said, hypothetically, if, for example, everybody in the United States, for example, were to buy physical silver or gold, they would actually suck up all the physical inventory there. And with that lack of supply, the price in that sense of silver cannot actually be suppressed any further.
The idea is good, but you know, if everybody jumps at the same time, you know, buildings might collapse. So getting everybody to do anything, you know, is wishful thinking. We don't need everybody to do something. We just need, you know, 10 Kyle Basses to start asking for delivery and see what the fireworks are gonna end up being.
Do you think with the increasing of retail investors buying physical silver all around the world, do you think they'll be able to break the leverage or the hold that the COMEX and even the ETFs that they have?
If there's enough demand, what it comes back down to is this: if I'm as a bullion dealer, if I'm able to pick up the phone and call a supplier who might be taking in some way be involved with COMEX, if I can buy the silver at the price COMEX states and have a reasonable expectation to be able to get that silver, then everything is fine. Once COMEX defaults and I'm not getting that silver, or I believe that COMEX is not going to give me have a delivery, then it's going to become an issue. And so it all comes back down: you're solvent until you're not. And in order for that to happen, you have to have a lot more demand. Yes, of course, people buying silver and there being more awareness. You see, silver Wall Street sort of movements, the silver squeeze movement, its power is not just that it causes people to buy more silver, but it's also making the issue, bringing awareness to it. And so if other people follow this Kyle Bass example, right, then that alone might start pushing these prices up. I mean, we live in a very complex world, and you never know what the catalyst is for things to really start. But what I can tell you is that there's definitely a lot of potential for a squeeze. But we should not expect that just because it's also in thing right now, within 2 months we're going to have that squeeze. So it's not like a GameStop number of shares where it's trading in one entity and it's a smaller market. This is a much more complex, bigger market. But I think the fundamental concept is very much alive and correct when it comes to silver.
Off the top of your head, are there any examples of fully backed silver or gold systems around the world? Systems that have actually, impressed you?
So we have to differentiate between, say, a facility and a system behind it. So quite a number of facilities I've been impressed by. In Germany, you have Pro Aurum. It's a bullion dealership, and it's very impressive the way they build it. And I always really liked it. When I first went to Freeport in Singapore, that was quite impressive. But when it comes to the systems that actually keep track of the silver, the more I learned about how the industry works, the less impressed I am by it. The more I sort of felt that we have to start from a clean slate and build something that is focused on being transparent and being practical, and yet also being efficient. And that's quite a challenge. And in the industries, there isn't really much demand for a system like that, only from consumers, but not from anybody in the industry. And the reason is, oftentimes, it's a lot simpler if you don't have to keep track of all your bars and where you put them. And it allows you to do things such as encumbering the bars, lending it out, especially if it's not bullion owned by the customer, but on your balance sheet. So not having such a system makes your life a lot easier as a vault operator or as a custodian, and allows you to do a lot more things. And a lot of customers, at least until recently, they will just look at paper silver and kind of look at it as being the same as physical. And because there's this lack of awareness, and they're kind of considering the same way, why would a company go through all the expense and the difficulties to try to create a transparent system? And if they have to charge a little bit more to do it, who's actually willing to buy it, to pay for that? And so it's very much, as a realization in the market becomes bigger, that it's actually a very important reason why you need to have the transparency. I think that the demand for better systems and so on is going to drive some innovation. But so far, I really haven't seen any systems that impress me, which is why we had to build ours. I've seen people which were trying to build them. And I give you an example. These systems oftentimes they implode because the scope is too big. I was talking with one company which had quite a bit of funding, and they tried to have tracking of gold and silver going from the mine. And once you start doing this, your task is so big because now you have to convince some Zimbabwe or Chilean, customs official and the truck driver over there to use your system and everything. And by the way, gold ends up being d'Or, so it's 90%, which rocks basically. And since that later goes to a refinery, and it's only when it becomes a refinery it actually becomes a bar. So while it sounds good in practice, and there's all these political, corporate, feel-good sort of reasons why you want to have tracking from the mine, in practice, it's really the work of the refinery to do that sourcing. And to build a usable system, you need to start from when the bar is created and then track, and you have to have something very different, to keep track of that other thing. And so because people sometimes think they want to track everything, and they think blockchain makes everything possible now, when it doesn't. Most of these projects already fail because of that reason. Another system where they wanted to have the tracking from the mine, and then I asked them, okay, and I'm looking at the data of what they were trying to do, and I'm saying, where does it state where the gold is right now? And he said, no, our client doesn't want to show where the gold is. He wants to show where it's coming from the mine, but he doesn't want to show where it is now. That's why not? Oh, I don't really know. So, now they don't want to show where it is. I mean, people always tell you because of security reasons, but sometimes there's another explanation that maybe it's that bullion has been leased to somebody who sold it, who then leased it and resold it, and now it's a problem. If you have a serial number, and many people sort of think they have a claim on that serial number, where is it? So suddenly there are all these things that have nothing to do with security, which are reasons why you don't want to show the transparency. So why don't we have a really nice, up-to-date, clear system in the industry to make all this work the way it should be? Well, because there are a lot of funny reasons why people don't want that. And because the public itself, until recently, there's more understanding of it coming now, has not really demanded it. I spent the last decade building such systems, and that's sort of why I'm kind of made it a mission, because I think it's really important for us to have clean tracking of gold and silver and other precious assets like that.
In fact, what are the challenges in designing, as you said, Gregor, a practical, efficient, and transparent kind of system that tracks the bars from the time they're created and follows them right through, whilst at the same time simultaneously having full silver and gold backing? I mean, that's a hard system to design, isn't it?
You need to make it practical. Nobody wants to use a system that causes them more work. So our system, GramChain, which is the latest iteration of these asset tracking system we built, and because we run our own vault, it's easy for us to go down to the vault and basically ask the guys, okay, what do you think of this, and how do you improve it, and how does the repackaging event work, and how do we make the interface simpler. The key to good systems is simplicity. And if you have the right data structure, you can get flexibility, meaning you can use the system in ways that you didn't think you would use it in the front. And so I used to be a senior data architect for banks, which basically means I construct data structures. And that's sort of what is really a key thing for a tracking system, because otherwise you build something that might work today, and then if you need to do something else tomorrow, you need to modify it. And if you modify a running system, you create a lot of trouble. And you have to keep on modifying. Eventually you have a monster which nobody knows anymore what's working where. So I think one of the key things is to make it as simple as possible. Make it so that people in the industry want to use it because it's making their life easier, or it's not adding much more work to it. And you need to make sure that you have quite a lot of value and a use case for it. Because people get bored if you tell them, yeah, here's a better way of tracking your bullion. Unless you're in the industry and understand the reasons why it's so needed, they don't really care. But if you can say, now that the bar is on this bar, this bar is on the system, and that gold, say, is in Switzerland, or it's in Dallas, or it's in Singapore, no matter where it is, as long as it's on here, you can take a loan against that bullion. It's still your ownership, but you can take a loan out of it because there's a peer-to-peer lending system which uses that gold as collateral. And remember, this is very different from leasing. Leasing is where I'm owing you silver or gold, and I'm taking what's owed to you and selling it to somebody else. P2P lending is your legal title owner of that bullion, and you yourself are saying, I have $100,000 worth of gold here, I want to take a $50,000 loan. Here's the conditions. We act as an escrow to basically hold that bullion for you. And if you have something like this, now it's kind of exciting, because if you can get a loan at 3%, say, for $50,000, then why not? Now we have a use case. So oftentimes just building the tracking system is just too boring for people, but having some applications on top of it, such as, in our case, the Cash Gold token is the first application. We'll be migrating our peer-to-peer systems on it, and we're going to have third-party applications coming in as well. Now you're creating an ecosystem. Now it's becoming interesting. So there are a lot of components like this. But I would sum it up: usability in terms of people being able to make use of it in some way, simplicity, and send flexibility of the data structure.
Well, thank you very much, Gregor, for taking the time to talk to us. We're just going to take a quick break and we'll be right back with you. This is the end of part 1 of our interview with the CEO of the Silver Bullion Group, Gregor Gregersen. Please join us for part 2, where we'll be continuing our chat with Gregor and learning more about the cash gold token system, the gram chain system, and the benefits and transparency that they will bring to ultimately, possibly even transform the fintech and bullion industry at large. Please join us then. The gram chain token system, the cash gold token system. Please join us for part 2, where we will be. Bet you Patrick never makes that mistake.